estimates on the third quarter performance, helped by an outperformance coming in from its oil to chemicals business. Analysts saw a healthy refining margin coming in for the company, the exploration business driving growth in 2023 itself. The stock, however, ended at the low point of trade. Sonia Shenoy joins in with more. Sonia.
Well, thanks a lot for that. Reliance Industries was a bit under pressure despite the numbers being better than what the street was estimating. Now, there were a lot of positives in the numbers. In fact, the oil to chemicals business surprised positively, where the EBITDA went up 16%, and it was a strong improvement in margins on the oil to chemicals business to about 10-odd%. Now, Reliance is undergoing a big capacity expansion plan where their capex went up by 16% sequentially at 37,600 crores. What Reliance is doing is, increasing their capex to drive the 5G rollout plan, as well as retail, which is seeing a very aggressive expansion, their retail business, where they're adding 6 million square feet, over 789 new stores. Now, a lot of brokerages are very bullish on the stock. JM Financial reiterated a buy with a target price of 29.50. They expect a robust 14 to 16% EPS compounded growth over the next 3 to 5 years. Nomura, Jefferies and JP Morgan have buys or overweights with target prices of anywhere between 28.50 to 31.10. But here's the niggling worry. Now, the debt of the company has gone up. The net debt has increased 18% quarter on quarter because of the capex towards the 5G rollout as well as the ramp up of the retail business. There's additionally no clarity on tariff hikes in the telecom business. Hence, a couple of these brokerages, despite remaining positive on the stock, have cut down their EPS estimates. Nomura has cut its FY23 EPS by 6%, while CLSA has cut the FY25 EPS by 8%. Back to you.
Sonia, thanks a lot for that. Let's talk about the fifth headline for the day then. Ultratech skid about 5%, and this despite decent volume growth in the third quarter. The street was worried about realizations. That failed to perk up in the third quarter, in fact. And in this quarter itself so far, we haven't seen price hikes come by for cement. The management also flagged rising input costs, saying that the overall cost trend for the sector is likely to stay elevated, as a result of which Shree Cement too was lower in today's trading session, along with all the other cement stocks. Nigel D'Souza joins in with the details. Nigel.
Well, that's right. Ultratech Cement's numbers are more or less in line, but the lower realizations, or the increase of just around 0.5% in comparison to around 2% that the street was working with on a sequential basis, seems to have spooked the street. And that's why it's not just Ultratech, the other stocks as well reacted negatively. Let's run you through the management commentary. Now, the street was hoping maybe there'll be some kind of clarity on the cement pricing itself, because first look at the numbers, well, it appeared that the realizations were a miss. But the management says that cement prices are likely to be stable. There's no concrete guidance in terms of price increases, and the street, well, they would be working with higher price increases for the fourth quarter as well as for FY24, which appears to be a little bit on the back burner. And profitability will be driven now by operating leverage. That's capacity utilization levels are likely to move up, as well as savings in terms of raw material cost as well. They did say though that demand is rock solid, and ahead of the election year, well, you're expecting demand to see a good pickup as well. So utilization levels for the past quarter were around 83%. They're expecting it to go up in quarter 4. The blended cost, of fuel in the past quarter was around $200 per ton. It didn't reduce on a sequential basis, but in the coming quarter, well, it could reduce by around $20-25 per ton, which will translate to roughly around 150 rupees on a per ton basis. The overall cost trend, though, is likely to stay up because of the ongoing conflict between Russia as well as Ukraine. Point number 1, China reopening, and no additional petcoke capacity coming on stream. Finally, capex, they're guiding for around 6 to around 7,000 crores per annum for the next few years. The numbers were in line. The problems in terms of realizations, volumes were solid, but clearly the street got spooked on the back of the realization miss as well as the commentary on pricing as well. Back to you.
Thanks a lot for that, Nigel. But hang in there, stay with us. JSW Steel was the other stock on our radar. It lost about 1% despite a good third quarter performance. What was weighing on the stock? Was it valuations?
Well, that's right. JSW Steel's numbers did beat estimates mildly so, and the margins could improve in quarter 4 as well. However, the street is a little bit skittish on the valuation front. To run you through the numbers first, the standalone EBITDA per ton will have delivered a good jump up in terms of the sequential number. It came in at more than 8,000 rupees per ton, which compares with less than 4,000 rupees per ton. There was a turnaround in their Bhushan Power and Steel assets that's come into their fold, which moved from a negative EBITDA number to a positive EBITDA number. And the European operations as well did quite well. However, brokerages, they're a little bit skittish. CLSA, well, they have a sell rating with a target price of around 640 rupees. They are working with the EBITDA per ton improving closer to around 12,000 rupees in the coming fiscal. However, they say that the capacity expansion is going to make JSW Steel more dependent on exports, which is lower margin business. They also highlight that the stock trades at more than 8 times EV upon EBITDA and around 2.2 times price to book. So valuation-wise, it's expensive. Jefferies, well, they retain they underperform with a target price of around 470 rupees. They say, in fact, the stock is expensive, trading at more than 2 times price to book for a company that's going to give ROE of close to around 10%. They have pulled back their EPS estimates by 11 to around 13%, and also they're nearly around 45 to 50% lower than what the consensus is working with. Finally, ICICI Securities, well, they have this sell rating on the stock with the target price of close to 550 rupees. They say that the company is more vulnerable in comparison to its peers on the steel cycle because of the high leverage that they have in their books. But all this together, the stock was under some pressure.
Considering the release of money from working capital, plus appreciation of rupee which is happening in this quarter, plus cash accruals that can happen in this quarter, all three together we will be able to reduce our debt.
All right, with that, it's a wrap on this edition of Markets Today. You stay tuned to CNBC TV 18. Thank you for watching.